Is that when you started?
Yep. That
Narrate?
was when I started Narrate. So I started Narrate in August of 2019. Within a very short time frame, had left a W-2 job, which I was a W-2 guy my whole career up to that point. So left my job, started a company, went through a divorce, and also went through the pandemic all at the same time.
Wow. So some change happened that year.
A lot of change that year. Yes. Hopefully it was not my midlife crisis, but it was definitely definitely a lot of change in that.
Did you buy a sports car that year?
No sport.
Okay.
No sports car that year.
Hey, Denver, Chris Lopez here, and today's podcast is going to be focused on the world of development. I've got a great guest in the studio today, Adam Fenton with Narrate, and he's going to come talk to us about how he's built his development business, some deals he's done, and the landscape he sees for development. Good morning, Adam.
Good morning. Thank you so much for having me.
Yeah, I'm excited to have you in here because obviously you got a great track record. And then I just love learning about new niches. So let's rewind the clock a little bit and kind of tell people how you got started, because you have quite the journey of starting out and having some great mentors and great opportunities along the way.
Yeah. So originally from small town Iowa, grew up, not even in a town, outside of a town of 965 people, and ultimately ended up going to college and thought I wanted to sell houses. So I thought I needed to go get a real estate degree to do so. So ended up getting a real estate and finance degree from the University of Northern Iowa, and quickly then went to work at a company called Principal Real Estate Investors, so Principal Financial Group, one of the largest investors in the U.S., based out of Des Moines, Iowa. So
their headquarters is there, right?
Headquartered in Des Moines. And I was working on projects in both Denver and Phoenix. So I was doing a lot of traveling, and really kind of got opened up to the rest of the world. And that was 06, 07. Then we all know what happened in 08. Was still working there. Was happy to have a job. And then once it was some pretty crazy times. As a new college graduate. So decided, as I felt things were starting to loosen up a little bit within the markets, thought it was my opportunity to probably escape Iowa. So I packed my bags in March of 2011 and moved to Denver. And had a job when I got here, worked that job for about 6 months, and was not really fulfilling or really happy. And a gentleman by the name of Eric Hagovic approached me. I had known him from my principal days, and we had done some deals together with some of the companies he had worked for here in Denver, and said he was going to a new company, and that there's a lot of capital behind it, and we were going to do development. So I said sure, and hopped on the bandwagon, having no idea what was going on. And I'll never forget it. Our second day, we were having coffee, and I was just very honest with him. I said, just so you know, I don't know anything about development. And he's like, I'm a land guy, so this ought to be fun. So we did that. I joined their Holland Partner Group, huge institutional investor out of the Pacific Northwest, and worked for those guys for 5 years here when I got to Denver from 2011 to 2015. And great learning experience. Eric's one of the smartest guys I've been around, deal maker, and really learned the ins and outs of the business, really from 2011 to 2015. And with those guys, built nearly 2,500 units and, about 300,000 feet of retail. So really, really, a great opportunity to learn the development business. So
was that in Denver or all across the?
That was all focused in Denver.
Okay.
So great learning opportunity, coming from a large organization where I knew about real estate, I knew how to underwrite it. I didn't really know about the ins and outs of development on a daily basis. And that's really where I started learning that skill set, and was given a lot of responsibility very early on, and it was just a sponge, and we had some great teams around us that helped me learn. So that's really where I really learned the development business. And then in 2015, was looking for something a little bit different. Holland was a great company, very institutional though, very big. and I wanted to feel a little more connected to the communities I was working in.
Okay.
So that's when I joined up with Matt Joblin at BMC Investments, and worked within development in Cherry Creek North for 4 years there, and had an opportunity to work on some amazing projects. That they just went through a rezoning there to allow for more height and density. So Joblin saw that as a huge opportunity, and as a visionary, and had an opportunity to work on some really, really great deals. It was a great learning experience for me as well, and would never have been able to start my own company without working for him and alongside him. The way he puts deals together and the way he thinks about things is unlike anyone I've ever been around. And being in the private equity, high net worth arena was something new to me, right? Everything previously was high level, very institutional. So if it was, you needed $50 million, I knew who to call, but $3 million, had no idea. So in how you structure the deals, when it's more private than it is, institutional is much different. So it was a great 4 years, and had an opportunity to really, hone those skills further and become, I think, more well-rounded, and ultimately gave me the confidence to be able to start my own thing.
Before we jump on to how you started Narrate, you casually mentioned, these two great mentors and opportunities you had. And I'm a big believer in, mentors and great opportunities to learn from.
Yeah.
How did you create those opportunities to get in with those guys so you could, have a great job, have a great opportunity, and also learn from some great people around town?
Yeah, it's a great question. And I think it's just putting yourself out there a little bit, yes, we are in the real estate business, but at the end of the day, the real estate business is the people business. And it's cliche, but it's really about who you know, not what you know. And that was one of those things where I had worked with Eric on some previous projects, and we had developed a friendship. And when I knew I was moving to Denver, I made sure that I was spending time with him, and it was really over beers one night where this opportunity came to be. So it was really just continuing to, I think, foster that relationship. And then, and he was a great mentor to me, and really allowed me to, really learn and grow. He was there to support it, but was very, was very helpful in that way. And then with Matt, I met Matt at the coffee shop one morning, Aviano in Cherry Creek, and I would go work out, and then I'd always go to the coffee shop. And
you bumped into him there.
We bumped into each other there, and we had I know one of Matt's cousins really well, and he kind of officially made the introduction, and then we would just see each other almost every day. And we would just talk about the business, and you develop a relationship over time with that. And it probably took 3 to 4 months of us chatting almost every morning. We were there almost at the same time, and
so just while you're grabbing coffee and
just grabbing coffee,
BS for a few minutes.
You'd be BS for a few minutes, and then he'd be sitting there. I'd go talk to him, or I'd be sitting there. He'd come talk to me, and we just kind of kept discussing. And then one day he was just like, "Hey, I don't know what you're thinking, but here's everything I have going on, and there might be an opportunity to work together here."
All right.
So so it's really kind of, I would say, just putting yourself out there a little bit, and creating what I would consider authentic relationships, where I wasn't really looking for anything, as I was developing those. And it was just, it was kind of natural. And then ultimately, by putting yourself out there and I think being genuine, people gravitate towards that a little bit, and the conversation just continued.
So did you go to like real estate meetups and networking events? Because I get, putting yourself out there, meeting people, but that's, especially now, kind of like post-COVID, it's hard to meet people now. Like a more tactical question.
Yeah.
How do you put yourself in a situation so you can be around great mentors like Eric and Matt?
I think, it's a great question. I do think I think NAIOP's a great program. I think ULI is a great, those are ULI, the Urban Land Institute. I think they're both great programs where I think you can get the initial introduction. But it really takes, I think, intentional follow-up, after that to create those relationships.
Okay.
So I think the networking events are great for the initial, that initial contact, and then taking it and kind of building it from there, if that makes sense. And
that makes sense.
I've got I was very active in ULI when I first came to Colorado. One of the guys that was in my wedding I met through ULI. So I mean, it's a really interesting, group of people that come together, and you never know what might come of it. So I think be willing and being open-minded, and going in, and some people will go in with a very, very direct idea of what they want to get out of it, where other people will just go there and meet and see what comes of it. So I think there's I think they are great resources to kind of get yourself out there a little bit.
Great. That's very helpful. Thanks. So, okay, moving back on to, was it after working with Matt? Is that when you started?
Yep. That was when I started Narrate. So I started Narrate in August of 2019. All within a very short time frame, had left a W-2 job, which I was a W-2 guy my whole career up to that point. So left my job, started a company, went through a divorce, and also went through the pandemic all at the same time.
Wow. So some change happened that year.
A lot of change that year. Yes. Hopefully it was not my midlife crisis, but it was definitely definitely a lot of change in that.
Did you buy a sports car that year?
No sports car that year.
So why did you decide to start Narrate?
I think it was one of those things, and you've probably, most of the listeners here probably know the book, and I read Rich Dad Poor Dad for like the 5th time. And, for anyone that hasn't read it, I would recommend you read it. And for anyone who has read it, I always recommend reading it again, because I think no matter where you are at in your journey and career, you can always take something from that book, and it's going to hit you in a different way. So this was literally probably the 5th time I read it. And it was either that book or the Cashflow Quadrant. There's one that comes after that.
Yep.
I don't remember which of the two it was in, but it was basically saying, hey, you think it's risky working for yourself. Yes, it might be at first getting started, but think about this. You build a whole life around your job that could be gone tomorrow, right? Like company could just pull it from you. So working for someone. So that was something that really, I think, stuck with me. So that was that really got the wheels turning. Number one. Number two is that I've been doing development for quite some time now. From 2011 to 2019, so call it 9 years, 8-9 years, and I felt I had the subject expertise to be able to do it on my own and execute, and felt like I had the capital relationships to be able to do it as well. So all three of those things combined together, and then I had young kids at the time, and quite frankly, just wanted a little more control over my time of when I was putting in the hours, right? I'm actually working more, but it might not be your typical 9 to 5.
Yeah.
So it was kind of all those factors combined together that ultimately I think gave me the confidence to be able to go out and start my own thing.
Okay. And so you got it started. Talk to us about some of the early deals you did, because that was obviously a new business, and then right when all the COVID craziness happened as well. So I mean,
so we were lucky. We had 2 deals that we had bought before the pandemic hit, and I think if we wouldn't have had those 2 deals, I'm not sure Narrate would have survived. But we have a little deal down in Rhino at 3354 Larimer that I had bought with a partner, Dan Hummel, and then had bought in 1250 South Pearl, which is a great site that we've since completed a building on in the Platt Park neighborhood.
Yep.
So we had those 2 deals. We had bought the land, and we had capitalized enough equity to get us through the pre-development process and basically through entitlements. So what that allowed us to do is, when the pandemic hit, right, everyone really didn't know what was going to happen. And I think everyone was freaked out, and, the world was falling. And, we took a step back and said, look, we can sit here and wait, or, if us along with our investors feel that this is a temporary thing, there might be, let's just kind of push forward and continue with the design of these buildings. So we talked with our investors, and ultimately the decision was made that we're gonna push forward with the design of these 2 projects. And that was, so that gave me something to do during the pandemic. We were busy, and it was a great decision, actually, because we positioned ourselves really well once we kind of got through that we had projects that were ready to go and ready to build. So it was, quite frankly, a little nerve wracking at that point in time, but we had our investors behind us with the confidence to kind of push forward. And I think that plays on a little bit to our strategy, which I know we'll get into a little bit, but I think in a time of unknown like that, these projects were so well located, and that's one of the things that we really focus on is location of our development projects. They were so well located that it gave everyone the confidence that, like, no matter what kind of happens in this short-term pandemic, that we ultimately know it was pretty short term now. Didn't know at that point in time, but I think it gave everyone the confidence that, like, these are great projects in great locations and it's going to make sense. So let's just push forward, even though there's some unknowns in the market right now.
So that old adage of location. Is that kind of like the number one?
That's one of the most important things for us. And I kind of always go back to this is, we're definitely more urban infill guys. And it just becomes from a demand thing, right? So at the end of the day, it costs the same amount of money to swing a hammer out in, the fields of Aurora as it does, downtown and urban location Denver, right? Like, lumber is the same. So a lot of your costs are the same, and your only differentiator at that point in time becomes the type of project you're going to build and what you pay for land. So we're in the mindset of, we will pay a little bit more for the land. I'm not saying we'll overpay for it. We'll pay fair market rate, but I just like the demand generators that are in place in those locations. And, we try to control everything we can from a risk perspective in these development deals, but there are certain things you can't, and rental rates being one of them. But we know in some of the locations that we pick, we're not going to control the rental rate, but we know there's always going to be demand for people to live in our buildings.
So and we're going to talk about the strategy and some deals here in a few minutes, but a lot of developers, among other real estate people, they got some black eyes and wiped out, with the, going from the low interest rates, the high rates, and just all the supply chain issues. How were you and Narrate able to navigate that?
We have done pretty well navigating it, and it quite frankly comes down to the debt that we put on them, and that is something that we control. And we had a great relationships with some banks, and a product that was available at that point in time was construction to perm loans. So these are 10-year loans that you're locked in for. It's it's fixed for the first 7 to 8 years, depending on time frame and bank. But essentially, that's what we put on these projects. So 3 of our 4 development projects that are going right now have this debt on it, right? So we're locked for the next 5 to 6 years at 3.75 debt. So there's no pressure to sell.
A lot less pain on the balance sheet too.
A lot less pain on the balance sheet as well. So it's kind of funny at that point in time. I'd get feedback from a lot of different debt folks and brokers, and it's like, oh, you're paying too. We could get you an interest rate at 3.25 versus 3.75, and
so it's about the 50 basis point spread between floating and fixed back then.
At that point in time, it was that was a component, and then another component is going to be your recourse. So you could get down to 3.25, you could get higher leverage, and you could get non-recourse. We decided we would be willing to take and they're only partial recourse, they're not full, but we decided we would take on a little bit of that recourse risk, and have a little bit higher rate, but it was quantifiable. And it really, at the end of the day, we look like geniuses, but it was really just a risk mitigation thing at that point in time. From some of the, that comes from my time with Matt Jodlin. He was a big believer in that product type and controlling your risks. And then when I was early in my career at Principal, during the 2008 financial crisis, I saw, development partners that we had, lose hundreds of millions of dollars, because of the debt that they had on these properties.
So out of I'm curious, because you have your finger on the pulse for developments and developers more than I do, the vast majority of developers went with the floating rate debt, right?
Yeah, that's definitely more consistent. And I don't know the percentage wise, but because most developers, their MO at the end of the day is to build it, stabilize it, and sell it. And when we went into our first project, we were looking at it more of a long-term hold. So we thought that debt made more sense. But yeah, so most developers are just going to put that construction debt on there. It's going to be a floater, probably over SOFR or prime. It's usually short-term in nature, 2 to 3 years typically, maybe with 1 or 2 extension options beyond that to get you to 4 to 5 years. That is the most typical construction debt and what most folks like to use.
Yeah.
So, and one other thing of the fixed rate that we did, right? There's an early exit fee of 1%.
It's not bad at all.
Which isn't bad at all, right? So, but that would be one of the things that some people would knock is what's a 1% exit fee? Why would I pay that if I know I'm gonna sell it? And I just always went back to if 1% is gonna make or break your deal, you probably shouldn't be selling it.
I like that rule of thumb. So it sounds like to me, like you said, hey, you look like a genius now, but you were wise enough to have that risk mitigation.
Yeah.
I mean, did you ever expect that rates would be this high back when you're doing your pro formas and the what if scenarios?
Never dreamed it. Never dreamed it would go that high that fast.
Yeah.
I think we always, when we would underwrite, we would put a little bit of a factor on top of where current rates were, but it was always usually 50 to 75 basis points. It wasn't 400 to 500 basis points, which is kind of what we've seen rates do for development projects. So I never dreamed that we would see something that quick, that fast. And most of my career, it's been in a pretty low interest rate environment starting in 2006. So I did not see that coming. But I'm really glad we had the debt in place.
I bet your investors are too.
Yeah. So it's just taking a lot of pressure off. And we get calls all the time. People think we're distressed. We have great debt. And then they're like, is it assumable? And we're like, unfortunately not.
Yeah.
But I think the bank would probably like to see it off their balance sheet as well.
Well, good for you, bad for them.
That's right.
So I want to kind of pivot forward now and kind of talk about, the strategy Narrate and just kind of the landscape.
Yeah.
Because there's a lot going on in Colorado. There's, just a lot in general. So like going forward, a lot like, hey, we know interest rates where they're at now. Yep. A lot of the supply chain stuff is stabilized. Like going forward, what do you see and what's the strategy for Narrate?
Yeah. It's a great question. So from Narrate's perspective, we're still active. We bought a site in Wash Park for ground up development in December. Right. So we're very active. I would
And I'm going to pause you there because that's actually, there's going to be another podcast we're doing. We're actually going to do a deep dive underwriting on there.
That's right.
So stay tuned for the nuts and bolts and the trenches on that deal he's talking about now.
Yeah. We'll get into the nitty gritty here, but so we're still very active. We're looking for really good deals at this point in time. So our spigot is not off, but I always say we're very, very picky, right? We probably pass on 99% of the stuff we see. But we still are believers in the Denver market. We are believers in the Colorado market, both short-term and long-term, right? We've got issues, no question, right? We've got affordability issues. We have the new mandate, the affordable mandate that's been put on new development in Denver, which is definitely crunching down on returns and things a little bit. But it doesn't mean it's dead. It's just everything that probably worked before isn't going to work now. But we're just being, really, really selective, and kind of back to my A++ location comment earlier. That's the type of stuff we're focused on, where we see, great opportunities, great demand drivers in place, can buy the land at a fair value. We're still active in that, in that realm. And, when you look at, just overall stuff from, across the entire United States, and depending on the publication you read, you're worth, 3.5 million to 6 million houses short across the U.S. So the demand is never going to go away. There are different ways to tackle this. Affordability is something that is creeping up everywhere, or lack of affordability, I should say.
Yep.
So we're working on some ideas around that as well. So I think the new mayor is doing a great job at the city of, getting development services kind of aligned down there, where the wait times on comments and entitlements is definitely shrinking down, which is a big deal, because that's where we take a lot of risk.
Is that improvement on their end, or just the lack of new permits and applications going in?
Yeah, I think it's probably a combination of a little bit of both, but I think a lot of it is things the city has done. And it got challenging there for a little while.
Yeah.
But we had a project that took 28 months to get entitled. That was 78 units. That's crazy.
What should it have? Like, what's a normal time frame?
So we did a 73 unit right before that took 10 months.
So 28 versus 10 months?
Yep,
Holy smokes.
So, and if you can imagine, we are buying, we had bought the land, we had raised money for the vertical development, and we had raised it for 12 months essentially. And that's the one thing is, these smaller guys like ourselves, right? We don't have huge amounts of money sitting around where we just go buy and can sit and wait. And we're raising money from investors along with our own money. And, so that puts a lot of pressure on us. So I'm happy to see that, the last handful of projects that I've worked on since then, seems to be straightened out quite a bit. And getting more streamlined here. So I think that's one thing that the city has done and recognized that they need to get better at. And that could be a huge bottleneck for new development projects going. And I think they're hitting that thing right on the head.
So looking out 10 years, 20, 34, 35, where is Narrate then?
Yeah, great question. I think, it's something we talk about often, and I don't know if we have a certain defined thing. But it'll be, we buy value add apartments as well. So we'll have, I would like to see us with about 5,000 to 6,000 units in the value add space. Over that time frame, and then still developing projects. I think we'll always be a developer. It's something that I have a passion for. I love taking something that might not be its highest and best use, and trying to create something that the community loves, that our residents love, that is good for our investors. Like that there's just something that's really fulfilling about that. And we're kind of starting to shift from kind of more of a build it, stabilize it, sell it strategy, which we needed to do for our first handful of deals, just to kind of show a track record and, proof of concept.
Yeah.
And now, I think going forward, one thing we are focusing on is doing development, but then holding it more long-term. Because I think a lot of the stuff that we're building are great long-term assets, right? We are not a merchant build. We are not the low-cost builder is how I kind of describe it, right? We spend a lot of time and effort on what the exterior design looks like, and then a lot of time on the interior design, because we spend 90% of our time indoors. So those, and when we look at it that way, those, in my opinion, create great long-term, assets and great locations.
Yeah, I mean, kind of one of the things I view things, for like a legacy asset, a long-term hold for me passed down. Like as I've, thought about that for myself and, all that next wave of my life, I'm like, wow, location always kind of comes to the top. It's like, man, the legacy, like, hey, I own C-class rentals here. I own stuff here, but it comes down to like, hey, location, man, I want to hold in downtown Fort Collins or wherever it is. Like, hey, it's an amazing location. You can't beat it.
That's right.
So is that like, I love it.
Yeah. Yep. And I would even say even our first handful of projects are that way. Just the capital partners we have on them are more, they're, it's a fund of family offices. So they're IRR driven. So of course, to get good IRRs, you have to sell in shorter time periods. So we'll sell at some point in time, probably the first handful of deals that we've delivered. But I think going forward, that strategy will ultimately end up shifting. And at the end of the day, it's long-term cash flow, right? Legacy assets and great locations that create long-term cash flow.
Yeah,
is kind of what we're all about long-term.
Right. All right. I know we're getting to the end of the show here, Adam, but I want to talk because you just shared before this podcast. I think you said about a week ago, you guys just closed on a property management company. Yeah. And obviously for, building and stabilizing projects are very important. For the long-term holds, it's very important. Yep. Why did you buy a PM company, and how is that going to make it better for your investors and your residents? Yeah,
it's a great question. So, and then there's a little bit of history here where my partner Zach Kobilka had owned this company previously, and they'd sold it, and there was an opportunity to buy it back. and thought we were getting a good deal on it. And like I mentioned earlier, we do own smaller buildings in the C-class asset space, and these guys are top-notch operator when it comes to that. So is it a moneymaker? Probably not. But at the end of the day, having that kind of direct control over the team and rental rates and controlling expenses, especially in today's market where taxes, insurance are just your uncontrollables are out of control. So being able to control everything else, I think, is a big deal. So I think that's number one. And then ultimately, I think we'd love to see us evolve into a portion of that company that can manage these A+ properties for us. Most of the product we build is sub 100 units. We think that's our specialty, is kind of that 75 to 150 units where it's really boutique, hands-on, kind of a high level experience for our residents. It's a really hard product to manage because it doesn't warrant an entire staff dedicated to the property. So you have to be able to share resources between properties. And quite frankly, I think a lot of the management companies out there are not set up to do that efficiently. And if we have a portfolio of these assets and we control them and manage them, I think we can help drive expenses a little bit lower because obviously we're the owner of the asset, so we have a very vested interest in trying to keep our expenses within reason. I know this is something that, talking with other buddies of mine who develop these type of properties, that's probably one of the biggest challenges of building these properties. It's the residents love it because it's smaller, hands-on, much more community feel. But from an ownership perspective, it can get a little bit inefficient when you try to manage them. So trying to wrap our head around that, and hopefully, I don't know if that's a 1-year thing, a 6-month thing, or a 3-year thing, but it's something where I see an opportunity, and I think we have the company now to help execute on that.
Well, congratulations on the acquisition of that. And
appreciate that.
Makes a lot of sense. And this has been a pleasure having you on a podcast. I really enjoyed getting to know you the last few months.
Yeah.
We've had quite a few mutual friends who just sang your praises. So I look forward to having you back more on the show, talking more deals. We got some deals coming down the pipeline too that we can work on together.
Yeah.
So everyone stay tuned. And if you have questions for us, you want to go into more development world, let us know. Adam's being very generous and will allow us to pick his brain.
Yeah, anytime.
Thank you so much, Adam.
All right. Hey, thank you so much, Chris. Really appreciate it.
Bye, everyone.